The company I'm going to be talking about today has witnessed a monumental shift in the popularity of its business, and this is one of the more boring businesses you can imagine, but this Canadian company has quietly put up over 300% returns over the last 5 years, and there was a large shift among Canadian consumers that ultimately caused this. In this bull versus bear case episode, I'm going to be going over Dollarama, which is one of the most popular Canadian stocks on the market today, and a lot of investors are wondering whether or not this company is still a buy after a massive run-up in share price. So I'm going to tackle the company today. I'm going to go over the bull case, the bear case, and my overall thoughts, whether or not I think this is an opportunity, and I'm going to do it all in less than 5 minutes. And as always, everybody, like the video, subscribe to the channel, comment down below, let me know what stock you want me to go over next, and there's a ton of free resources in the description below. You can grab them absolutely free, including my top 3 options for 2025. It takes just seconds to sign up, and it's going to help you become a better investor. But let's get right into the video. So Dollarama, what is Dollarama? Well, the name kind of says it all. It is a dollar store. It primarily operates here in Canada, but it does have Latin American exposure due to its acquisition of Dollar City. So it's expanding relatively fast down there, and is a very popular store in terms of utilization by the lower class, the middle class, in terms of overall consumer items. Now, the bull case, and this is going to be solely from a macroeconomic basis. We have a large shift in terms of the cost of living here in Canada. We are zero question in a cost of living crisis. And what companies tend to benefit from that crisis? Well, they tend to be the discount stores. We have high costs of housing, high rent, we have high utility bills, we have high vehicle prices, we have large unemployment, we have high interest rates, large mortgage rates. People are looking to save wherever they can, and because of this, Dollarama has witnessed a monumental shift in consumer habits. So the chart I'm going to show you here is same-store sales growth. We see a gigantic surge in 2023. What happened in 2023? Inflation was high, interest rates started going up, and ultimately consumers were looking to pinch pennies and start to save. Now, we see a big run-up in 2024 as the trend continues, and now we see a slowdown in 2025. However, this is on a comparable sales growth basis. So the fact that Dollarama can still grow comparable sales by 4.6%, we can definitely see here that the momentum is large. People are shifting to more discount items, whether the quality is there or not. Some people would argue the quality is not there, but people really don't care when they're looking for, ways to pay their mortgage, pay their car bill, feed their family. Now, will this continue? I do believe the shift is permanent. Is it going to be as large as it was in 2023 and 2024? No, that's probably not feasible, but there is still a shift here, and it's still well in motion. Now, the other bull case is Dollarama is just a outstanding operator. We look to a US-based company like Dollar Tree. There is zero question that Dollarama is the better operator. We look quickly here to operating margins. We're looking at 9.7% for Dollar Tree, and we're looking at 25% for Dollarama. So what ends up happening here is you have a much more profitable business. If we look to Dollar Tree revenue of $14.59 billion compared to Dollarama's $6.25 billion, and then we have free cash flow that is effectively the same. So Dollarama is generating the exact same amount of free cash flow on less than half the revenue. It is the most efficient discount dollar store type company in North America, and its stock price has reflected that. So bear case here, bear case would be that macro cycle slowing down, Canadians maybe opening up their wallets a bit and heading back to probably main brand type items and not necessarily discounted, China source type items. I'd say there is a low likelihood of this happening at large scale. It's just that the growth will ultimately slow because Dollarama will have absorbed all of the consumer shift in spending. As a result, we have a double-pronged bear effect here is valuations. Valuations are high. If we look to the company right now, it's trading at 44x trailing earnings. Typically, this company over the last 5 years has traded at 30. So we're looking at a near 50% premium to historical valuations. When we look to a free cash flow basis, we can see the company's trading at around 30x free cash flow. And typically over the last 5 years, this company has traded at 25.5. Now, the company does warrant a larger valuation multiple based on the success it has had recently. But we can see here in early 2024, it really spiked. And I would say that this company is priced to perfection right now. It needs to be able to maintain that mid-single digit comparable sales growth, and it's only guiding to 3 to 4% comparable sales growth in the future. The company is pretty much saying that growth will slow. I think it's fairly expensive at these prices, and I'd definitely be a little bit cautious. So my overall thoughts on Dollarama: one of the best companies in the country, one of the most efficient operators for a retail company. It has done very well, but there is also the added element that it had some tailwinds over the last while in terms of consumer shifting that it really didn't do much to garner. I mean, this was just an element of high inflation and overall, Canadians looking to pinch pennies. If that slows, the company could go through a period of flat returns, maybe even declining returns. I wouldn't be a buyer here. I think the margin of safety here is quite limited, and I think there's a lot of risk here for relatively little reward unless we see a big continued shift in Canadians looking to pinch pennies. Don't get me wrong, Dollarama is one of the best businesses in the country, but you have to understand what you're paying in terms of valuation multiples, and I wouldn't pay this. So everybody, hope you liked the video. Head down below, like the video, subscribe to the channel, comment, let me know what stock you want me to go over next. And as always, ton of free reports in the description. You can sign up for free to help you become a better investor, and stay tuned for more great Canadian content.